The global silver market, worth hundreds of billions of dollars, just collapsed. Not because of a recession, not because of a market crash, but because of a single executive order that nobody saw coming. And while the world laughs at headlines about frozen islands and political theater, the bullion banks in London and New York are in absolute panic mode. Because buried in that announcement, hidden behind the noise, is one sentence that just severed the lifeline of the entire Western silver supply chain. The trap has been set, the metal is locked in, and what happens next will rewrite the rules of the precious metals market forever. If you own silver, if you're thinking about buying silver, or if you think this doesn't affect you, you need to hear this right now. Welcome back to Predictable Currency, Silver. You know, my friend, in all my years analyzing these markets, I've learned one thing. When the system breaks, it doesn't announce itself with sirens and flashing lights. It happens quietly. On a Sunday morning, in a tweet that most people scroll past without a second thought. And if you've been with us on this channel, if you've been following our analysis, then you know we don't chase headlines. We dig deeper. We connect dots that others miss. Now, I need you to do something for me. If you appreciate the work we do here, the real research, not the recycled noise, go ahead and hit that subscribe button. I know. You've heard this 1,000 times on YouTube. But here's the thing. You and we're not kids anymore. We've seen enough markets, enough cycles, enough experts come and go. So when I ask you to subscribe, I'm asking you to bookmark a source you can trust when the chaos hits. Fair enough? And one more thing, drop a comment and tell me, where in the world are you watching this from? Because what's happening right now, it's not just an American story, it's not just a European story. This affects every single person holding silver, trading silver, or relying on the dollar-based commodity system. So tell me, are you watching from the United States, Europe, Asia, Middle East, Pakistan? Let me know in the comments. I'm genuinely curious who's paying attention to this. It is Sunday, January 18th, 2026. The date will be remembered. President Trump has just announced a 10% tariff on all imports from 8 European nations, including the United Kingdom, effective February 1st. If a deal over Greenland is not reached, that tariff escalates to 25% by June 1st. To most people, this sounds like politics, a headline, another chapter in the never-ending trade war saga. But to the risk managers at JP Morgan, HSBC, and every major bullion bank operating between New York and London, this is a nuclear event. Let me explain why this matters, and why this changes everything. The global silver market operates on a principle called fungibility. This is the idea that 1 ounce of silver in London is exactly the same as 1 ounce of silver in New York. More importantly, it relies on the assumption that this silver can move freely between these two cities without significant cost or friction. For decades, the major banks have played a game. A very profitable game. When silver prices spike in New York due to high demand, the banks pull metal out of their vaults in London, specifically from the LBMA, the London Bullion Market Association, and fly it across the Atlantic to flood the New York market and suppress the price. Conversely, when London runs low on inventory, which has been happening with increasing frequency due to massive demand from India and China, the banks take silver out of the COMEX vaults in New York and ship it to London to keep the system stable. This back and forth flow of physical metal is the lifeline of price control. It allows the banks to create the illusion of abundant supply. It allows them to smooth out regional shortages. It allows them to maintain the fiction that there is always enough silver to go around. But President Trump's 10% tariff just shattered that entire structure. Here's the problem. The United Kingdom is on the tariff list. The LBMA, the heart of global silver trade, is located in London. This means that starting February 1st, any silver that moves from the United States to London and then tries to return to the United States will be hit with a 10% import tax. At current prices of around $90 per ounce, that's a $9 penalty per ounce. For the bullion banks operating on razor-thin margins, this is not a minor inconvenience. This is a profit-destroying barrier that makes the entire arbitrage game mathematically impossible. Think about what this means in practical terms. A bullion bank in New York looks at the situation in London. They see that the LBMA is running critically low on physical inventory. They see that prices in London are starting to spike. In the old world, the world that existed just 48 hours ago, they would simply authorize a shipment of a few million ounces from their COMEX vault to their London vault. Problem solved. Price stabilized, game continues. But now, that same risk manager has to ask a different question. If we send this silver to London today, and we need it back in New York next month to settle a futures contract, we'll have to pay a 10% tariff to bring it home. That $9 per ounce doesn't just eat into profit, it wipes out the entire trade. It makes the transaction a guaranteed loss. So the decision is simple. Don't send the silver, and just like that, the flow stops. The Atlantic pipeline, the invisible conveyor belt that has kept the silver market liquid for decades, has been severed. President Trump has turned the United States border into a one-way valve. Silver can enter, but it cannot leave. not without paying a penalty that destroys the economics of the trade. This creates what traders call a trapped inventory scenario. The metal that is currently sitting in COMEX vaults in New York, it's staying there because no bank is going to risk exporting it to London if they can't bring it back without taking a massive loss. And the silver that was supposed to be shipped to London this week to bail out the LBMA, it's grounded, it's stuck, it's not moving. This is happening at the worst possible time for London. We know, based on publicly available vault data, that the LBMA has been hemorrhaging physical silver for years. The relentless demand from India and China has drained London's reserves to historic lows. The vaults are nearly empty. The float, the unallocated silver that backs millions of paper claims, has evaporated. London was counting on New York to save them. They were waiting for the cavalry to arrive from across the Atlantic. But the cavalry isn't coming. And that's when the real crisis begins. There's an old concept in commodity trading that every major bank's risk department understands instinctively. It's called the location swap. In normal market conditions, silver is treated as a liquid asset. It flows like water across borders, across oceans, across continents. If JP Morgan has too much inventory sitting in their New York vault and not enough in London, they don't always ship the physical metal immediately. Instead, they execute a swap. They trade ownership of bars in New York for ownership of bars in London with another bank or institution. It's clean, it's efficient, it's profitable. The entire system is built on one critical assumption, that eventually, when needed, the physical metal can be moved to balance the books without penalty. That an ounce of silver in New York is worth the same as an ounce of silver in London. That the cost of moving it, insurance, shipping, storage, is manageable and predictable. But President Trump's 10% tariff just obliterated that assumption. He has turned the United States bullion market into what traders are now calling a Roach Motel. You know the old pest control slogan, roaches check in, but they don't check out. Well, now it's silver checks into the US, but it doesn't check out. Let me walk you through the logic that every single risk manager on Wall Street is grappling with right now, on a Sunday, no less, when they should be watching football or spending time with their families. Imagine you're a senior trader at a major bullion bank. You're sitting at your desk, you see the reports coming in from London, the LBMA is in trouble, vault inventories are critically low. There's a scramble for physical metal. Prices are starting to spike in the London market. Your instinct, your training, tells you to act. Ship silver from your COMEX vault in New York to your LBMA vault in London. Stabilize the price, protect your positions, do what you've always done. So you authorize the shipment, 1 million ounces, 2 million. It doesn't matter, you put it on a plane, it lands at Heathrow, it gets delivered to your London vault. Crisis averted, for now, but then what? What happens 4 weeks from now when the COMEX in New York starts running dry? What happens when you need that silver back in the United States to settle contracts, to meet delivery obligations, to cover short positions? That's when the trap closes. Because that silver, your silver, is now sitting in the United Kingdom. And under President Trump's new tariff rules, bringing it back into the United States means paying a 10% import tax. If silver is trading at $90 per ounce, you now owe the US government $9 for every single ounce you try to bring home. That $9 comes directly out of your bottom line. And in the ultra-low margin world of bullion banking, where profits are measured in fractions of a percent, a 10% hit is not just a loss, it's a catastrophe. It wipes out the economics of the trade 10 times over. It makes the entire operation a guaranteed money-losing proposition. So the risk manager looks at the spreadsheet, runs the numbers, and makes the only rational decision available. We are not sending the silver to London, because once that metal leaves US soil, it effectively costs 110% of spot price to get it back. The silver is trapped. And this, my friends, is what destroys the entire price suppression mechanism that has kept silver artificially cheap for years. The banks can no longer play whack-a-mole with regional price spikes. If London explodes to $120 per ounce while New York sits at $90, the banks cannot step in to arbitrage the difference. The tariff wall is in the way. The logistics are broken. The game is over. This creates something economists call market segmentation. It means we're about to witness wildly different prices for the exact same asset depending on where that asset is physically located. Silver in New York? That's American silver, strategic silver, silver that cannot leave. Silver in London? That's stranded silver, isolated silver, silver that cannot be reinforced. And here's where it gets really interesting. And this is the part that most analysts are missing. This tariff policy, whether intentional or accidental, has just created a domestic strategic reserve for the United States. Think about it. We've talked for years about the need to secure critical minerals for national security. We've discussed how silver is essential for defense systems, solar panels, electric vehicles, electronics, and countless industrial applications. We've worried about supply chain vulnerabilities. Well, this tariff solves that problem overnight. If the banks cannot export silver to London because of the tax risk, that silver stays in the United States. It stays in the COMEX vaults. It stays available for American manufacturers, for Tesla, for Raytheon, for the US Mint. It forces what traders call the ghost supply. The silver that exists in vaults, but is constantly shuffled around the world to remain within American borders. It is America First applied to the periodic table. It forces the rest of the world, specifically Europe and the United Kingdom, to fend for themselves. It tells London, you're on your own. You cannot raid our vaults to stabilize your exchange anymore. And this puts the LBMA into what can only be described as a death spiral. London is the hub of the global physical silver trade. It's where the vast majority of metal destined for India and China flows through. If London loses access to the US stockpile, which is exactly what's happening, they have zero buffer left, their vaults are empty, the float is gone, and now the resupply line has been cut. Let's go back to that 4.2 million ounces that were withdrawn from the COMEX on Friday, January 16th, just 2 days ago. On Friday, when we first saw that massive withdrawal, many analysts, including some very smart people, assumed that metal was leaving the country, heading to London, heading to Asia, leaving the United States. But now, with this tariff announcement dropping on Sunday, that metal is almost certainly stuck. It's sitting in a warehouse somewhere near JFK Airport or Newark or LAX, wrapped in plastic, loaded on pallets, with nowhere to go. Because whoever owns that silver now has a choice to make. Option A, ship it to London, and accept that if you ever need it back in the US, you'll pay a 10% penalty. Option B, keep it in the United States and sell it to a domestic buyer. A manufacturer, a dealer, a private vault. Given the uncertainty, given the risk, given the math, the smart move is option B, which means that metal, those 4.2 million ounces, is staying in the United States. And if that's true, if millions of ounces that were supposed to leave are now staying, then the physical squeeze in the American market might ease slightly in the very short term. But the physical squeeze in London, that's about to go nuclear. Because silver is a globally traded asset, you cannot have silver trading at $200 in London and $90 in New York for very long. The psychological panic spreads. The contagion begins. The system breaks. And when London breaks, the whole world watches. Let's shift our focus across the Atlantic Ocean. Because while New York is dealing with trapped inventory and a one-way valve at the border, London is facing something far more immediate and far more catastrophic. The London Bullion Market Association, the LBMA, is not like the COMEX in New York. The COMEX is primarily a futures exchange. It's a casino where paper contracts get traded back and forth. Most contracts never result in physical delivery. It's speculation. It's leverage. It's financial engineering. But London is different. The LBMA is where the real physical deals get done. It's where the big institutional players, the sovereign wealth funds, the central banks, the major manufacturers, come to buy and sell actual metal. It's where the bars change hands. It's where tonnage moves. And for the last 3 years, London has been bleeding out. We've watched, month after month, quarter after quarter, a relentless exodus of silver flowing out of LBMA vaults toward India and China. The numbers are staggering. Hundreds of millions of ounces have left the system. The inventory that remains is at levels that many veteran traders consider critically low, perhaps even dangerously low. The amount of silver in London that is truly unallocated, meaning it's not already spoken for, not already owned by an ETF, not already pledged as collateral, is frighteningly small. London has been surviving on one thing, access to New York's supply. When things got tight in London, when the vaults started running dry, when demand from Asia threatened to overwhelm available inventory, they could always make a phone call. They could always arrange a shipment from the COMEX. They could always tap into the American stockpile to buy themselves time. That was the lifeline. That was the escape hatch. That was the plan. But yesterday, Sunday, January 18th, 2026, President Trump cut that lifeline. By imposing a 10% tariff on imports from the United Kingdom, he made the New York to London transaction financially toxic. No rational bank is going to ship silver to London if bringing it back means eating a 10% loss. So London is now an island, literally and financially. They are cut off from the COMEX. They are cut off from Mexican mine supply that flows through American refiners. And they are still facing the insatiable, unrelenting demand from the East. This creates what military strategists would call a siege scenario. When the trading day begins on Monday morning in London, in just a few hours from now, the professionals in that market are going to wake up to a brutal realization. They are insolvent in physical terms. They have sold more silver than they can access. They have written more claims than they have bars to back them. And the backup supply from across the Atlantic, the supply they were counting on, is not coming. This is the setup for a localized default. And here's where things get truly strange. and truly dangerous for the global system. We could very easily see a scenario where silver trades at $90 in New York, but $110 or even $120 in London. Why? Because in London, the metal is scarcer, the supply is constrained, the demand is overwhelming, and because of the tariff wall, that price difference cannot be arbitraged away. In a normal market, if London silver jumped to $110 while New York sat at $90, traders would immediately buy in New York, ship to London, and sell for a profit. That arbitrage activity would quickly close the gap and bring prices back into alignment. But the tariff makes that arbitrage impossible. The 9 per ounce penalty eliminates the profit. The price gap persists. This destroys the concept of a single global spot price for silver. If you have one price in Shanghai, a different price in London, and yet another price in New York, which one is the real price? The answer is simple. The real price is wherever you can actually get the metal. And right now, if you're in London, getting metal is about to become very, very difficult. This bifurcation, this splitting of the market into isolated regional pools, is an absolute nightmare for the major banks. Here's why. Most large banks run what's called a global book. They have positions all over the world. They might be long silver in London and short silver in New York. Under normal circumstances, these positions offset each other. They're hedged. The risk is balanced. But when the price in London screams higher than New York, that hedge breaks. Suddenly, they're losing money on the spread. Their models stop working. Their risk calculations fall apart. This forces them to close positions. They have to buy back their shorts in New York. They have to sell their longs in London. They have to scramble. And when they scramble, they create buying pressure in the New York market. So here's the counterintuitive outcome that a lot of people are going to miss. The tariff that traps silver in the United States doesn't crash the US price. It actually forces the US price higher because the banks, in order to protect themselves from the London disaster, have to buy COMEX contracts to rebalance their broken hedges. The trapped inventory creates a panic bid. Now let's talk about something that should terrify anyone holding unallocated silver accounts in London. Millions of investors around the world hold unallocated silver with LBMA member banks. This is essentially a fractional reserve system for precious metals. The bank takes your money, credits your account with a certain number of ounces, but they don't actually set aside specific bars with your name on them. Your silver is pooled with everyone else's silver. This system works fine, as long as not everyone asks for their metal at the same time. But if London gets cut off from supply, which is exactly what's happening, the risk of an unallocated default skyrockets. If you hold unallocated silver in London right now, you're essentially holding a paper IOU from a bank that just lost access to its primary supplier. When the market realizes that London is under siege, we should expect a massive run on unallocated accounts. Investors will panic. They'll rush to convert their paper claims into physical allocated bars. They'll demand delivery, but there aren't enough bars. The vaults are nearly empty. The metal isn't there. So what do the banks do? They go into the open market and start bidding for any silver they can find, at any price, from any source. And that's how a liquidity crisis turns into a solvency crisis. That's how a regional problem becomes a global contagion. The Greenland tariff has exposed the fundamental fragility of the entire system. It has revealed that the global silver market is not one unified ocean. It's a series of connected pools, and right now, one of those pools, London, is draining fast. Meanwhile, the other pool, New York, is filling up with trapped capital that cannot escape. This makes the United States market the safest, most secure market in the world for physical silver. If you own silver in the United States, if you have bars in your possession, in your safe, in your vault, you are holding strategic inventory. You're holding an asset that cannot leave the country. An asset that American industry needs. An asset that the government has accidentally ring-fenced and protected. But if you own paper silver in London, if you hold an unallocated account, if you own shares in a London-based ETF, you are holding a liability that is about to be stress-tested in ways it was never designed to handle. The divergence between these two markets is going to create chaos. On Monday morning, we might see arbitrage bots malfunctioning. We might see trading halts. We might see emergency announcements from exchanges. This is what happens when the logistics break. The pricing mechanism fails. The illusion of liquidity evaporates. And it all traces back to a tariff designed to pressure Denmark into selling an island covered in ice. We have reached the end of this analysis. And if you've stayed with us through all 4 parts, you now understand something that 99% of investors, even professional investors, have not yet grasped. The world of silver that existed on Friday, January 16th, 2026, no longer exists. The global, frictionless, unified silver market that has operated for decades has been fractured by a single executive order. President Trump's Greenland tariff has reintroduced the laws of physics and geography into a market that had forgotten them. So what does the future look like? Let's be clear about what we are not going to do. We are not going to make a specific price prediction for Monday morning's open. We're not going to tell you that silver will gap up to $110 or crash down to $75. Anyone who claims to know exactly what will happen in the next 24 hours is either lying to you or lying to themselves. The banks might attempt one last desperate smash to shake out weak hands, or the market might gap higher immediately as the reality of the situation sinks in. We don't know. Nobody knows. But here's what we do know. We are entering a new era, an era of regional pricing, an era of fragmented markets, an era where the location of the metal matters more than the metal itself. In this new world, silver sitting inside the United States will trade at a premium. It will be valued as strategic silver, silver that cannot leave, silver that American industry needs, silver that the U.S. government has, intentionally or accidentally, secured within its borders. Meanwhile, silver sitting in London will be stranded silver, disconnected from the primary source of new mine supply in the Americas, isolated from the COMEX, vulnerable to continued drainage from Asian demand. This bifurcation destroys the ability of the commercial banks to suppress the price using their traditional methods. Price suppression requires two things: leverage and certainty. The banks need to be able to short massive amounts of paper contracts with confidence that if they get into trouble, they can source physical metal from somewhere, anywhere, to cover their positions. But the tariff introduces basis risk, the risk that metal in location A cannot be moved to location B without a catastrophic cost. That is the banker's worst nightmare. When banks face unquantifiable, unhedgeable risk, they do one thing. They reduce exposure. They stop shorting. They pull back. They exit the game. The paper shorts are leaving the building because the game has become too dangerous to play. And without the artificial suppression, without the constant shorting and the constant metal shuffling to defend those shorts, silver will finally be free to find its natural equilibrium price. What is that price? It's the price high enough to incentivize new mining production in a world where energy costs are elevated and environmental regulations are tight. It's the price that reflects silver's role as the unsung hero of the digital economy, essential for solar panels, electric vehicles, 5G infrastructure, and military systems. It's the price that compensates holders for taking possession of a physical asset in a world where supply chains are fracturing and trust in institutions is eroding. We don't know the exact number, but we know it's significantly higher than $90. So what should you, the individual American investor, do with this information? Strategy. Number one, geographic diversification is dead. In the old globalized world, it made sense to spread your assets across multiple jurisdictions. A little gold in Switzerland, some silver in Singapore, maybe some coins in Canada. But in a world of trade wars, tariffs, and resource nationalism, moving metal across borders is becoming prohibitively expensive or outright impossible. The safest place for your silver is where you are. If you live in the United States, your silver should be in the United States, preferably in your physical possession or in a domestic vault that you control. Do not rely on foreign storage. Do not trust unallocated accounts. Do not assume you can just ship it back if things get bad. The walls are going up. The borders are hardening. Strategy number two, ignore the spot price. The spot price you see on financial websites, and cable news is now essentially a mathematical error. It's an average of multiple broken markets that can no longer equilibrate with each other. Instead of asking, what's the spot price of silver? You need to ask, what's the replacement cost? If you sold your silver stack today, could you buy it back tomorrow? At what price? What premium would you have to pay? That replacement cost, not the spot price, is the true value of your metal. And as this crisis deepens, as the physical shortages become undeniable, that replacement cost is going to climb higher and higher. Strategy number three, think long-term. The tariff on the United Kingdom is just the opening act. This is the first domino in a much larger shift toward resource nationalism and supply chain security. Every country, not just the United States, is going to start asking, do we have enough critical minerals within our borders? Are we too dependent on imports? What happens if trade routes get disrupted? The answer to those questions is going to be, we need to hoard what we have. We are returning to a world where hard assets, physical commodities that you can touch, weigh, and store, are the only form of collateral that truly matters. Paper promises, digital ledgers, and unallocated accounts are all downstream from one question. Where is the actual metal? And if the answer is, we do not know, or it's trapped in another jurisdiction, or it doesn't exist, then the paper is worthless. The tariff trap has locked the door. The silver is staying in America. The game has changed. As we head into this week, as the markets open, as the chaos unfolds, as the headlines scream and the analysts scramble, expect confusion. Expect volatility. Expect wild price swings and contradictory statements from the banks and the media. But you now understand the underlying reality. You know that the logistics have snapped. You know that London is cut off. You know that the trapped inventory in New York is actually a bullish development for US holders. So hold your position. Do not panic. Do not get shaken out by short-term volatility or by media narratives designed to confuse you. The trajectory is up. The fundamentals are screaming. The floor is solid. The government has, whether intentionally or accidentally, rigged the game in favor of the physical holder. And if you've been stacking silver, if you've been quietly accumulating while everyone else chased meme stocks and crypto, your patience is about to be rewarded. Thank you for being part of the predictable currency community. Thank you for seeking out real analysis instead of recycled headlines. Thank you for thinking independently in a world that wants you to follow the herd. If this analysis helped you understand what's really happening, if it connected dots that no one else is connecting, do me a favor. Go down to the comments section right now and type, "Staying with the original." Let the algorithm know you're here for the real research. Let other viewers know they found the right channel. And let's build a community of people who see through the noise. The week ahead is going to be one for the history books. Stay safe, stay focused, and keep your eyes on the physical reality, not the paper illusion. We'll see you on the other side of the market open. And remember, in a world of chaos, silver is certainty. Subscribe, hit the notification bell, and let's navigate this together.